Hello, YouTube. We have a bullish pattern here, which is a hammer and a bullish engulfing and a reclaim of our 50 moving average. But the big question for me is whether or not it's going to hold. And the reason I say that is because Jerome Powell is going to be speaking on both Tuesday and Wednesday, providing testimony to Congress, which means that it's going to be really watchly closed. And Larry Summers, who is the former U.S. Secretary, is telling us here that the Fed is behind the curve. So what is Jerome going to do? He's going to have to think really hard. And he's going to be getting grilled for 2 days. So yes, there is a very bullish pattern here, and we cannot ignore that. It's a bullish engulfing candle. We're above the previous high, and we've reclaimed our 50 moving average. That is like really significant. So we're going to go through this weekend and try to make our best guess on where we're going to go, and we're going to try to make sure you have all the supporting evidence to make sure you can make an informed decision. And I say that because I think we're at the turning point, but what I'm noticing is that there is a lot of liquidity to suck up from the bulls and from the bears around this 50 MA. So if we think about this a little bit objectively, let's zoom back in now. So what happens? Well, there's a push-pull happening off of this blue line. And all the blue line means is the short-term price. So when we're above, it's bullish because we're above the short-term price. When we fall below, we're bearish. Why? Well, because we're below the short-term price. We go above, come back down. Go below, come back up. That's called mean reversion. We're reverting back to the mean, which is the short-term price. So the question is whether or not the short-term price is ultimately going to lead to a turning point, which is going to make us go higher, or a turning point that's going to make us go lower. I also want to mention this week that what I think is going to happen is what I personally think. What we have to keep in mind is that the market is not one person. It is a collective of everything, everywhere, all the time. So is Jerome going to say what he's been saying for a while, or are we going to have more of a walk back where, again, he's been saying the word disinflation a lot, the market rallied on the back of it. So does that mean that there are wheels in motion which can keep going higher, or is that train kind of already baked in all of the gravy we're going to be getting? Let's jump in a little bit further. Let's look at the data, and then we're going to look at some really important charts because I think that there is a lot for us to glean from here. But let's just get this stuff out of the way. All right, so we got Jerome Tuesday, Wednesday. Larry Summers, again, this guy is like pretty smart, and I know that Jerome's listening to what he has to say. Everyone quotes him. So when he says the Fed is behind the curve, and they should be open to a 50 basis point hike. Trust me, people are listening. They're paying attention, including the Fed. This is also a week where fear and greed is going to be fear and greed is really volatile, which just means that, man, a month ago we were at greed, like in extreme greed, actually. Then we go down to greed a week ago. Then we go down to 49. And within one day, we punch up 6 points. Man, things are just jostulating like really, really big right now. And why is that important? Well, it's important because the moves on the chart are getting extreme, and we're not going to realize what the true move is until it's hindsight. And I say that because as we now look here, there is more of a consensus in terms of us going up and down. So fear and greed is neutral. And at least for this poll, thank you to everyone who answers these. We're now back to 50-50 when before we were mostly looking for down, 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 down ever since the beginning of the year. So it's difficult to call, but the indicators give us a very clear story. So Jerome's going to speak on both Tuesday and Wednesday. It's going to be a multi-hour thing because he starts at 10 a.m. just after the market opens, speaking all day on Wednesday. And then we're going to have Christine Lagarde speaking too. But again, we're focused on U.S. markets. So the third most important data point is going to be non-farm payroll coming in on Friday. There's 2 important numbers here. We got the non-farm payroll, which means jobs added. Then we also have the unemployment rate, currently expected to come in line at 3.4. So remember, Jerome has not explicitly said this. He says we need slackness in the labor market. What he's basically saying is we need people to lose their jobs. So as we think about the data that's going to be unfolding and the current positioning, meaning fear and greed, if we get this number, unemployment rate coming in at 3.4, that is like the number the Fed cares most about. But I happen to think we're going to focus on this non-farm payroll number here. So let's look and see what the preview is. Well, the preview is that it's going to be coming in at 200 when previous readings are going for 517. That was the blowout number that came out that tanked the market going into February. It came out February 3rd. If we look back, 233, 263, they're all coming in green or beats. So the question for me is whether or not coming in at 200 is going to be at 200 or lower, meaning if it's red and we miss, is that going to be interpreted bullish? Or if it comes in hot, are we going to actually see more of the same? Why? Man, this is like a strong market. 400,000, 390, 370, 520, 300. So I think what's really important is not again, there's the news versus the reaction to the news. So if the news comes in at 200, I think that could cause some relief after we get a nice little fade from Jerome. So we'll look at the charts in a moment to support that. But we talked about how we could go down before going up. That's what I'm basically laying out. So I'm going to lay out what I think is my base case, but I'm also going to go over what I think would be bearish and what I think would be bullish. So we're going to lay out a few different scenarios. What if this? What if that? But I want you to understand the context here. And I'm going to only ask you once, if you wouldn't mind, please smashing that thumbs up and consider subscribing to the channel. We put out stock market videos every single day. Thank you so much ahead of time. I really appreciate it. All right, moving forward. So what I want to do here is just make sure that we understand fundamentally what 200,000 jobs added are versus what the reaction to the news could be. Because frankly, if we're not fighting the tape versus not fighting the Fed right now, those are two different things. So if we remove the the C word and we zoom in here, okay, well, it looks like about 200,000 is like the average, right? All right, so we got some months where we do 1,000,000, some months where we do 400, but like 200, like that's like just like the low end, right? 200 is like the low end. Almost every month is above that. Let's actually zoom out because I want to see whether or not historically 200,000 is enough or not. Because if the Fed wants slackness in the labor market, historically, is 200,000 strong or weak? Well, it's not weak. We need to go to negative, like in 2001 or in 2008, 2009. Man, we only have one negative reading. It's only in 2020. Let's zoom back in and see what it is. Actually, do we have a negative reading here? No, everyone is actually, oh, sorry, we got a negative one here on the first, January of 2021. Otherwise, every single number, other than what happened like into 2020, which we all know about, there's not one negative print. So I think, again, not I know, but I think that the bulls might try to latch onto this number into Friday. And notably, if we get a dip down early in the week on Jerome, that's what I'm really thinking about. If we think about the emotions, we also have to think about positioning, because if we look back to those same periods, 2016, I can't go back to 2008. Let's go to max, actually, see if we can get that. That's the maximum. So this is the CFTC speculators net positioning for the S&P 500 futures. And because there is expiry coming in on the 10th, we have to pay attention to it. Why does it matter? Well, look, in 2015, 2016, there is this period of extended net short positioning, which means that people are betting against the market, but there are periods where they cover, right? They cover into late 2015 in December, they add it back on, then they go back to net positive. Well, ever since June of 2022, we flipped negative, and it's been pretty solid here at 200 for a very extended period. In 2020, they removed it, went back to neutral, went back to net long. Now, man, they're big short, and they're not relenting. Why does this matter? I just mentioned it. We have the E-mini futures, which are going to be expiring here on the 10th, which is going to be this this Friday coming up. We're going to be switching contracts over. If that confuses you, just know that the E-mini futures are going to be rolling over. And then on the 17th, we also have monthly expiry, which happens to be quad witching. So there's some dates that are in mind here. We got the 10th. The 10th, or this Friday coming up, is going to be E-mini futures expiring. So that's the 10th. And then on the Wednesday, which I believe, I'm just guessing right now, I think it's going to be on the Wednesday. I think it's going to be the 14th. That's going to be VIX-piration. That's going to be on the VIX. And it matters because when we look here to the VIX, man, it's been getting drilled from 25 back down to the teens. Is that a coincidence? Or is there some manipulation in play here? We'll find out. So VIX expires next Wednesday. And then we got the big expiry for SPY, SPX, and all of those different ETFs, exchanges, and all that good stuff expiring after single stocks, all of it. And when we look here to the S&P, we note that we have a period where I mentioned this, I think on Wednesday, Thursday, and then on Friday, we're almost at the first impulse move here where we stop going down. We have our short-term downtrend, just like we do here. We break back over it, and ironically, we leave a gap here. That's what's so interesting. We leave a gap on the chart, and we left a gap on the chart here. So are we going to ultimately shoot a little bit higher, which I was looking for about 404, 405. Bingo, 404. We got it. So are we now due for a nice flush to fill the gap before maybe we rally back up? I'm pretty confident that we're going to fill this gap here. I'm just not sure if it's going to happen on a power flush. So as I'm trying to forecast what could happen, I think this right here, if it happens, I think it would happen on Tuesday. And I think it would be Jerome that would cause it. So again, we're getting a little bit of a preview here. We have a few different templates to look at as well. So we'll do the charting at the very end, but I'll show you exactly what I'm looking at here. It's that gap where we ultimately, we invalidate our head and shoulders, which we talked about earlier. So let's make this yellow so it's a little bit easier to stand out. We get our head and shoulders here. Ultimately, we go higher. We invalidate it by closing above the neckline. Looking at what we have now, let me actually just flip this back here. All right, let's go back to yellow. What do we know? Well, here we have that same pattern where we have a head and shoulders. And at least in my opinion, by getting above 401.44 or the white line, which goes back to our June gap here, what that does is it actually starts to invalidate the pattern. So it's not a head and shoulders if we fail to hold the neckline, which is roughly that 401 area. So as we're starting to ascend or move higher, right, getting knocked up, not knocked down, what I'll be watching for is going to be the reaction to 404 early in the week, because if I'm correct that Jerome's going to take us down, which I think he has to, I think he has to pound that same narrative, because we have the FOMC meeting coming up on, man, I actually forget when that is. That's actually a really important day too. It's usually right around expiry. March 21, 22. That'll be shortly after expiry, or the 17th. So I think that's a pretty big coincidence, and I think it's also very interesting. So two things I just want to mention here really fast on the chart, because this is a daily chart, but we're going to focus on weekly and monthly in a moment. Here we were also talking about how we had the Dow as a template. When we get our golden cross, we crash land in our 50, and then what? Well, to be determined. So let's go back to that template briefly and see if it gives us any clues here. Let's go to the Dow. We look here at crash land in the 50, and then that same thing we showed you on QQQ, where there's a push-pull or mean reversion happening on the 50 here. Well, is that what can maybe happen to SPY? So if that's what's going to happen to SPY, we should push-pull off the 50, but kind of hold it, which means we shouldn't really deviate too far from it, which means this move at 405 should get faded. That's what should happen. So even though we're seeing a bullish pattern, is it going to get faded? Maybe. And here's the part where we could invalidate this down move. Again, we have that same head and shoulders. We got the knees and toes, and we bounce back up. So if we're going to bounce back up to maybe get to like 410 on SPY, here's what I'll be watching for. It's really simple for me. It's whether or not we're going to hold the 200 moving average. So as we zoom in a little bit closer here, here's the part that's missing on the S&P to confirm it, right? We don't have a close below the 200 here. So we come down, slam off the 50, bounce up, bounce, bounce. So what's happened on SPY? Oh, well, we got part of it, but not all of it. So if we flip to a line chart, right, the humble line chart, it doesn't show us a test of the 200 because this only looks at the closing price. But if now we go back to candles here, we did test it, right? We got pretty close with 2 days, and then we went below it, which means we actually did not just find support on the 50, but this is a pretty explosive move off of it. So we're already starting to notice some chinks in that armor or that thesis. But until we get a daily close below the 200, I think, again, not I know, but I think that this template could be in play, where if we're going to just hug the 50, I'm going to believe it until we print a weekly lower low and close below the 200. Otherwise, you look here to the S&P, and the most likely scenario that I see forming here is an attempt at a full cup and handle eventually when we complete it. I don't know that we're going to form a new high, but so far we're already about here. We left the gap, we pushed off the 50, we got over our downtrend. Man, it's starting to really line up here. And these guys just won't relent, so make them pay. Why? Because on the 10th, we have ES rollover. On the 14th, we're going to have VIXpiration. And then we also have the big expiry coming in on the 17th. And positioning is pretty bearish right now. We look here to, actually, let's look at everything here a little bit more objectively. So what we're looking at here is called our platform, the algo.com. We're looking at options. We're looking at the last rolling 30 days, which means let's actually just look at the overview here. It's from the 2nd of February to the 4th of March, which means the last rolling 30 days. And what did we notice? SPX tilted bear, but not by a lot. SPY, 2x, right? We got 1.3 billion short, 700 million long. QQQ, 800 million short, 300 million long. And as a caveat here, we're also looking at orders over $100,000 that have not yet expired, which means money that is still up for grabs. We look at Tesla, 800 million long, 400 million short. If we're going to go for max pain, Tesla should fade into expiry. For Amazon, man, that's a pretty big short, 658 million short, and it's only 100 million long. So that means that Amazon should melt higher. For other ones, it's a little bit less skewed, right? Apple, Meta, but it's actually not 100% bearish like it has been previously. But for the indices, meaning SPY, QQQ, it's tilted pretty bear. And this is what I'm going to show you here now. So we're looking at the 17th of March expiry on the monthly, which is going to coincide with that quad witching. If quad witching confuses you, all it means is that there's 4 things expiring. We usually get every 3 months or at the close of every quarter. It's either triple witching or quad witching, which just means that there's single stocks expiring, there's index expiring, there's options. Sorry, there's futures. And then there's also derivatives and all that good jazz. I might be a little bit off on that, but it just means a lot of things are expiring at the same time. So there's motivation for a push pull. So if we look here at the 16s, here's what I want you to focus on. We're going to look at the open interest, which means if they're trying to burn premium, we have to see where the premium is. I just showed you with the overview, but now we're going to look at the actual chain for SPY. This might not be the best gauge, but it's also the one that's tilted the most bearish when we looked at that overview. Again, 1.3 billion short versus about 700 million long, or a 2-to-1. So on the option side here, let's actually zoom in a little bit closer. I actually can't. So here we notice that there's not more than 100,000 in premium for any of the call strikes. So we got 82,000 here at 400. That's the biggest one so far. But look at the put side, 113 at 400. And we're going to zoom out more. There's also a lot of volume here. So now let's look beyond. We're going to look at all, which just means that we're looking at all the different expiries here. So let's go all the way to the top here. We're looking at about 400. And we look and note that, okay, 82,000, 37.59, 81 up here at 420. So yeah, we could go higher, but like these things are worth like cents. They're not worth a lot. We'll look on the put side though. Let's look and see where there is 100K, 400, 394, 390, 385 is pretty close. It's 90, 93 here. We look at 380, 120. We look at 370, 105. Okay, well, yeah, these things are worth cents too, but there's a lot of motivation or premium, which is what we just looked at on the overview from our platform, thealgo.com. Link in the description if you want to find out more. If not, I think we just gave you the high level thing there. So all of that matters because even if we're fundamentally bearish and we're going to be getting that bearish move, if their goal is to burn premium, we know where we should be going. It's probably higher. It's not going to be a straight line. The bears are going to fight it because of that net short positioning. And then we got the March 22nd meeting with the Fed, which will be the Wednesday after the quarterly expiry. That's really important. Why? Because if Jerome's going to be really hawkish, but all the premium is mostly tied up into the March 17th expiry, they're not going to have enough time to cash in, which is why options are a little bit tricky. You got to be right about price, direction, timing, IV or volatility. And that's like stacking it against you versus if you're going to be accumulating a position that's just going to go with or against you. There we go. Sort of a little bit of a detail this week because we can't deny there's a bullish pattern. We look here on SPY. Yes, bullish engulfing weekly candle. We close over the 50 again. We're over the previous weekly high. Cannot deny that's bullish. My spidey senses are just tingling, and I have to just be aware of it. So if we break bull, I'm going to trade it. But I'm also aware that Tuesday could be the highest volatility day this week, where we could be getting a slam. And if we get a slam and a gap fill and a bounce, man, I'll be flipping bullish. All right, let's just go through a couple of charts because I'm a little bit over on time. And I just want to make sure that we leave some room to, for content later this week. So here we're going to look at the right-hand side is going to be the monthly chart. And on the left-hand side here, we're going to have the weekly chart. So all this shows us is that as the monthly chart is forming over here on the right-hand side, what's the quality? When we look over here at the weekly chart. So now, even though we know that we're over the 50, over the month previous weekly high, now let's drill down a little bit further into our monthly chart because this is where we need to see leadership from the NASDAQ and then also leadership from, we need to see leadership from the NASDAQ to continue to drag us higher because that's what's really holding us up here. So last month we had a failed breakout, which means we broke out but failed to hold the range. Well, now so far this month on this candle, we have a failed breakdown. So this is a failing market, right? It's failing. That's what's happening. Here's the caveat. Because this was a failed breakout, what we want to pay attention to is the level where it qualifies as a failed breakout. And right now, that's right here at 408.16. 408.16 is going to be the previous monthly high going back to January. So for us to say that this failed breakdown is valid and it invalidates the failed breakout, we have to get above 409. So as a quick cheat sheet, I've been using about 409, meaning that if we're over it, that's bullish. If we fall below 400, then we are bearish. These are just the numbers that I had from the previous week. Again, you can join me for a pro membership at thealgo.com if you want to see all my S&P 500 notes after I sign off because I trade this baby all day. I trade it all week. I love the S&P. That's my favorite stock. Moving forward. So all that means is that right now, failed breakout, failed breakdown, but we don't quite invalidate the previous pattern. They also pushed nicely off 395. I was looking for a push up here to about 410. So I see the short-term gains for the bulls maxing out at about $5. And then we watch and see what the reaction is to 410 to potentially squeeze back up here to about 415, as we showed you on that daily chart. All right, now let's go to QQQ. If you look here at QQQ, here's where it's already done what we need to do on SPY to invalidate it. So we have to ask ourselves, is 3 candles more significant for time? Yes. In terms of overall significance, we have a much bigger pattern, which currently has how many bars here? We got 31 bars. So 10 times more significant because there's 10 times more time and the volume is all bearish. But short term is what moves the market week to week, day by day, month to month. But the long term will usually self manifest as we showed with that net positioning on the S&P 500. And until it flips less bearish to potentially bullish, this might just be a trap. But we cannot deny the bullish price action we showed you on the weekly, and it is feeding through tier 2 on the monthly. So we look at this move here, weekly bullish engulfing back over the 50 weekly. On the monthly chart, what that looks like is, let's go back here. And what it shows us is that we've now actually gotten back above the high from January. And that's so significant because it means that this failed breakout is starting, it's invalidated as of now, if it holds all the way into, I believe, March 31st, which will be the last calendar day of the month. So if that happens, well, man, it's a trappy market. We're range bound. We're not really getting a big move, which means what? We're sucking up all the liquidity on the 50 before we get that turning point. So I think that's enough. I think we're going to leave it there. There was a lot more I wanted to go through, but I think I left you with a lot of nuggets to be prepared for this week. And if you wouldn't mind watching the weekend video from last weekend, I think that'll give you some more insight in terms of how we formed this current weekly move. And if you're still enjoying the content, please consider subscribing. We appreciate all of you in our YouTube community. Thank you so much.